Welcome to topic 4, Statement of Profit or Loss. We'll also be covering off on the Statement of Comprehensive Income and the Statement of Changes in Equity. There are a whole range of learning objectives, not surprisingly, but within this we're going to look at kind of why financial performance is important and the purpose of it. We'll look at a couple of really important accounting concepts. So we'll look at the reporting period concepts as well as the difference between accrual accounting and cash accounting. And there's a very clear and important difference between the two. We're going to continue on our journey on talking about accounting policy choices and just the impact that these things can have. We'll then move into the framework side of things, so the measurement and the definition and classification of income. Finishing up with definitions on classification and recognition of expenses and also of income then with recognition. Finally, looking at what a statement of profit or loss looks like and discussing a little bit about alternative performance measures, because as you've probably seen if you've started looking through some financial statements, there's a whole range of different profit figures in there. And not only are there different profit figures within the statement, there's also profit figures which are outside the statements which often get talked about. Finally, we'll touch on briefly this idea of comprehensive income and changes in equity. And then to finish up with, we'll look at the relationship between the statement of profit or loss and the statement of financial position. The statement of profit or loss reflects the accounting return for an entity over a specified period of time. And that's really important. It's the accounting return. As we've already started to discover, there are things which get included for accounting purposes in the accounting reports, and there are things which don't. So when we're looking at the statement of profit or loss, we're very much considering what is included within income, within expenses, and the difference between those two is your profit. Income, we've talked about in terms of a definitional point of view. Income comprises two things, revenues and gains. And the best way to think about how these two things are different is revenue arises from the normal things a business does. So normally if you're a retailer, you sell product. That's what you do. You may earn service fees for doing other things. You may get dividends if you invest in other companies. So these are sort of things you normally do. Gains are still good. I mean, you're still getting a benefit from it. And as an owner, there is definitely an upside to that. But gains are about things which aren't normally happening within the business. So if you're a retailer and you had some property, some land or land and buildings that you sell, the gain that you get from selling those land and buildings would be a gain. It's not revenue. It's not what you normally do. So if you, for example, are an airline and you run, you send passengers all around the world, then revenue is the money you get from passengers and freight and whatnot. You'd make a gain by selling the aircraft. However, an aircraft manufacturer, their normal business is making and selling planes, so selling a plane for them would be revenue. So understanding what the business is could mean what would be exactly the same thing could get treated differently because of what the business actually is. So the first of these concepts which are really important, and it's the reporting period. And if you're going to have performance, it has to be for a specified period of time. It can't just be, I made $1 million. Did you make that over 1 month, 6 months, a year, 10 years, 100 years? That period really does make a difference. And it's an arbitrary period, but then again, years are, there is a good reason why years are what they are. But the arbitrary convention that we have is for accounting purposes, you have 12-month periods. So you have annual reports. A lot of companies in Australia will or have to produce 6-monthly reports. In different jurisdictions, you may see quarterly reporting as well. But the reporting period is an important thing. So it means up until a point in time, all of that revenue and all those expenses get included within that period. And then you sort of start again for the next period. It's not specifically a calendar year. It doesn't have to be the normal for in Australia, the normal sort of business year ending 30th or the financial year ending 30th of June. You can have financial statements ending at any time during the year. The second of the big concepts is accrual accounting. And this is required by accounting standards. So if you're a reporting entity, you need to use accrual accounting. If you're a smaller business, cash accounting is generally something you can get away with. And it's a lot easier and simpler to do. So the idea behind accrual accounting, and we'll dig into this in a little bit more detail, is a system where the transaction and events are recorded when they occur, regardless of whether cash is received or paid. So you're not looking for when cash moves. What you're looking for is, from a revenue point of view, have you performed the service or have you sold the good? From an expense point of view, have you incurred the expense? Not whether you've paid it, but just have you incurred it? From a cash accounting point of view, you're not looking at when the actual event happens, you're just looking at for when cash moves. And it's often easy to follow cash, which is why it's used by smaller businesses. But it can lead to some problems in terms of actually properly recording how a company or an entity has performed over a period of time. And so we look at these are 4 different situations where we have to, where we see expenses and revenues, I suppose, move differently from accrual to cash accounting. So if we look at the top left quadrant, accrued income, in this case, income is earned but no cash received. And an example of this is that you have provided a service. So you might have already provided accounting services, for example, and you've billed the client, but you have not yet been paid. The important thing though is you have done the work. So from a performance point of view, you would get to include that as revenue. The opposite of that is you have been paid, but have not yet earned the income. And a really good example of this is airlines. So airlines will receive cash for flights. So they receive that. I can't think of, certainly not commercial operations, where you can pay for the flight after you've taken it. So you'll pay for the flight before you take it. So the airlines have received all this cash, but they've not actually provided the service yet. They've not flown you from point A to point B. They have a liability sitting there. They haven't received, they haven't done any service, so they don't have revenue, but they have a liability because they owe you a service. If we move down to the bottom left, we're now looking at expenses. So for accrued expenses, these are expenses which have been used or consumed but not yet paid for. An example of this would be staff who have worked for you and you haven't paid them yet. So you've used up, that sounds, when you look at the expenses being used or consumed, that sounds bad when we're talking about people, but you have used their human capital, you've used their resource, to help do, help your business do what it needs to do, and you haven't paid for them yet. And for a lot of staff, that would generally be the way that it happens, in that you will work for, in Australia, commonly 2 weeks. In other countries, the UK commonly, or at least my experience has been, a month, is that you'll work for a period of time and then you'll be paid at the end of that. So from the business point of view, they've got the benefit and they've used up that expense, but they've not yet paid for it. So we need to record something. And again, we'll look at examples of these in more detail in another video, which will actually go through a set of worked examples with numbers attached. The last in the quadrant is prepaid expenses, which is when you have paid cash in advance, but the expense has not yet been used or consumed. And insurance is a really good example of this. It sort of defeats the purpose, but you can't pay for insurance after the fact. I mean, if you could, it wouldn't really be insurance. So insurance, if you're going to get the benefit from it, you have to buy it up front, and then you get the insurance benefit, the coverage from it over a period of time. That's the benefit that you'll get. And so you don't show an expense at the time that the cash moves. All you're effectively doing is swapping one asset, cash, for another asset, a prepaid expense. Again, coming back round to something we started touching on in topic 3, so the previous topic, around policy choices and estimates and judgments. So GAAP, so the standards that we use and the choices that we're allowed to make, they do allow choice. They do allow choices when transactions are being recorded, and they do require estimations by preparers. And the reported profit or loss figures will be affected by these decisions, whether it be a policy choice decision or an estimation around the numbers involved. So examples of this could be, and we've touched on a few of these already, an inventory costing method. So the actual method you use, whether it be FIFO or whether it be weighted average, that's a difference in choice. When we're looking at property, plant, and equipment, the valuation method used, again, that's a choice that could be taken. Or finally with development expenditure, whether you capitalize or whether you expense that development. So if we just focus on that last one for a little bit, obviously there's a lot of money being spent looking for cures for various diseases, obviously quite an important one right at the moment. The money that gets spent, if it sort of falls under the banner of development expenditure, and that's not for the scope of this subject, but if you are interested, I can absolutely point you in the direction of detail as to what allows an entity to count it as development. But if it's development, an entity could choose to capitalize or to expense it. So say cash has gone out, so your cash asset has gone down. So on the left-hand side, cash has gone down. Then you've got to choose, how do you balance that? If you capitalize it, all you're doing is replacing cash with another asset. There is no impact on profit or loss. Your balance sheet overall stays the same. It just changes from one asset to another. If you were to choose to expense it, cash as an asset goes down and profit will go down, so equity will go down. So your balance sheet looks a little bit worse because you don't have as many assets there, and your profit looks a little bit worse because you have now less profit because you've got more expense. That has a very real impact on both your balance sheet, so your statement of financial position, and your statement of profit or loss. Moving to accounting estimates, we've seen a few of examples of these as well. So the useful life of depreciable assets. If we choose 5 years for the useful life or 10 years for the useful life, that will have a mechanical effect on the amount of depreciation expense recorded each year, which will then have an impact on your profit that you show. Property, plant, and equipment residual value. If we choose to have a higher or lower residual value at the end, again, that will have a mechanical effect on the depreciation expense, which will then have an effect on your profit for the year, purely by an accounting choice or accounting estimate choice in this example. And lastly, around employee benefits. So things like long service leave in Australia, these require 10 years worth of employment at an organization to be able to be eligible. But there's a whole range of decisions and estimations around how many staff are going to be left after 10 years, what's their salary going to be like at that point in time, what discount rate to use. So there's a lot of estimation involved in that, and it's, can be quite complicated. So again, these things will ultimately have an effect on both the profit and loss statement, so statement of financial performance, and the statement of financial position. The quality of earnings. Now, this doesn't mean, now on the face of it, you sort of read quality of earnings, you think, oh, well, a company making lots of earnings has good quality of earnings, and a company making not many earnings has not very good quality of earnings. And that's not quite what we're getting at here. What quality of earnings means is, I suppose, how much can we rely on it? Like how verifiable is it? How much can we use it and be comfortable that it is actually telling us what is going on? So the manager's use of accounting discretion their use of discretion and estimation can affect earnings. And people use earnings. People in the market will use earnings to get a sense of how this business is going. So from a valuation perspective, profit is often also included in various contracts. that exist between the entity and external parties. It could be with the executive team. It could be with suppliers. There's lots of examples of where profit numbers in some way, shape, or form are included within contracts. The manager's choices that they make may portray economic reality or be driven by self-interest. And so when I say they driven by self-interest, what we're saying is there a reason why management would do it which would potentially benefit them or their company? So if a company is deciding on, say, the useful life of property, plant, and equipment, they may decide to lengthen out that useful life. And by lengthening out that useful life, it will have a reduction in the depreciation expense each year and therefore an increase in profit. It could be because that particular piece of property, plant, and equipment is going to last longer than what they originally thought. Or it could be that they just want to show a higher profit. From the outside, it may be difficult to actually understand what drives those choices, but that's why, hopefully the auditors and the regulators will be able to kind of, check up on this and make sure things have been done correctly. So this example is an article from the Australian Financial Review from 2016 in relation to Slater and Gordon, which is a law firm which became a public company. So they're referring to judgments being made around how they're recording revenue. I'd suggest go and have a look at the article in full, or just do some Googling around Slater and Gordon and some of their accounting issues that happened, because it's definitely worth a read. But in here, I'll just read this out. The WIP calculations, and WIP refers to work in progress. The WIP calculations are supported by undocumented judgments on estimated fees, probability of success, and percentage of completion. ASIC Head of Audit Doug Niven wrote in an email to Commissioner John Price on September 9, 2015. Subject to further discussion with the company, these judgments do not appear fully consistent with our own analysis of historical data and performance. So why this is important is if you sell a coffee to someone, what we're looking for from a revenue point of view is how much of the job have you completed? Selling a coffee, you sell the coffee, job's done. When it's things which happen over a period of time, work is being done over that period. So it's unfair to have them have to wait until right at the end of the completion. So this idea of percentage of completion method is that how much of the job has been done, and you get to record revenue based on how much of the job has been done. But to do that, someone like Slater and Gordon would have to actually estimate what the revenue would be from any particular case, what the likelihood of success is going to be, how much of the job has been completed. Those all have a level of subjectivity. And if there is a reason why you would want to, and I'm not asserting this here, but if there was a reason why you'd want to increase your revenue in a particular year, you could start playing around with the inputs. You could boost the estimated fees. You could boost the probability of success, or you could boost the percentage of completion. Alternatively, if you wanted to reduce your revenue in a given year, and there are reasons to do that, you could just do the opposite. So again, with certain transactions and certain sort of situations, there becomes a greater scope to be able to make choices that actually affect the profit and loss statement. So we already touched a little bit about measuring financial performance. So to measure profit or loss, all income and expense items need to be identified and measured. And income, just as a reminder, income is increases in assets or decreases in liabilities that result in increases in equity other than those relating to contributions from holders of equity claims. So it's, if you've gone and done work and somebody has paid you cash to do it, that's an increase in cash and that will increase your equity. And it's not like the owners have just put in more money into the business. So you've got it from someone other than the owners. Expenses, on the other hand, are just the opposite. Expenses are decreases in assets or increases in liabilities that result in decreases in equity, other than those relating to distributions to the holders of equity claims. Income is often classified by type. sales, fees, commissions, interest, royalties, rent. So the type of income that you get. And obviously within an internal system, you wouldn't just want to have sales as just one big overarching sort of sales account. You'd maybe want it by store or by region, even by sort of salesperson. So you can actually break that down and become quite granular from an internal point of view. But from an external point of view, they only need to be sort of grouped into major classes. Expenses, on the other hand, classified by nature or function. Larger entities usually aggregate expenses into classes. And what you'll see here is things like cost of goods sold, sales and administration, marketing, depreciation, finance costs. Now, an expense would certainly be wages, salaries, human capital type expenses. There is no requirement that wages is separated out and shown on its own. So marketing would have wages within it. Sales and admin would have wages in it. Even cost of goods sold, if there is direct labor inputs, could actually have components of wages in there. So again, it's hard from the outside to actually understand exactly what the wage bill is for any particular entity. So now that we sort of measured and understand kind of roughly how that measurement works, and as I said, if you look at the example video, there's an example video with a number of different examples. I mean, it's an example video that has a number of different income and expense situations with the entries for it. So you can kind of see some of what we're getting at with some numbers attached. So recognition here refers to recording items in the financial statements with a monetary value assigned to them. So this is Woolworth's 2017 statement of profit or loss. And up the top, we have revenue from sales of goods and services, and we have other operating revenue, but you can see it's pretty immaterial. So just for ease of use, this is kind of sales revenue. This is, you go into Woolies and you buy some bananas or toilet paper if you can find any, and that's total operating revenue. They then have cost of sales. And cost of sales, as you'll soon see, is just the cost of buying all the inventory in. And so it's the cost of the inventory that you bought in that you've sold. So to make this $55.6 billion in sales, the inventory costs them $39.7. The difference is gross profit. So the $15.9 billion is their markup. That's how much they're getting over and above what it costs them to buy in. They then have other revenue. There is no note to it. We don't know what it is. It's just something else. The two main expenses, in this case, outside of finance and tax and whatnot, they literally have two. It's branch expenses and admin expenses. So branch expenses, I'd imagine, would include things like lease on shops, utilities, staff at those branches, all the various things to make sure those branches and those stores run. So that's cost them $10.6 billion. Admin costs them about $3 billion. That gives them earnings before interest and tax, so EBIT. They then have their finance costs. That gives them profit before tax. They then have their tax expense. Now, important, tax expense doesn't necessarily mean tax paid. Tax paid you'll find in the cash flow statement. And that gives them the profit for the period from continuing operations of $1.4 billion or $1.5 billion. Underneath that, discontinued operations. So what happens is from time to time, businesses will get rid of a business. There may be a variety of different strategic reasons why that's the case. We can get an inkling as to why that was in 2016 because their profit or loss from discontinued operations, it was a loss of $3 billion. We don't know what their prior losses on that business was, but it looks like whatever they got rid of wasn't doing all that well. So it probably makes sense why they got rid of it. And that gives them ultimately the whole profit or loss for the period of 1.6. The reason why you separate these two out, continuing and discontinued operations, is because if you're making investment decisions and you're using some of this information to help you do that, you want to know what that business looks like going forward. So you want to know what the continuing operations are. The discontinued operations would actually just would kind of mask the actual things which are continuing on. So you want to strip that out. For our purposes, we don't talk much about non-controlling interests, so we won't touch on that here. For those that are doing further accounting, you will talk about non-controlling interests, and then they talk about just the breakdown of this equity holder, or the equity holders of the parent. So this section down the bottom here is not something we really need to focus on. There is a prescribed format for general purpose financial statements. So these are statements which are being used by companies that have to provide this information in accordance with accounting standards. If you're a smaller entity, there's different sort of scope to do things, but we're going to focus on reporting entities. And so what they need to report is revenue, which from Woolworths we just saw, and if you go back to it or download it yourself, they had revenue. They had costs of sales. It's a retailer, so it is appropriate. They had finance costs. They had a share of profit or loss of associates and joint ventures. They didn't have that. Didn't look like it's that much of an issue in this particular case. And it's also not relevant for us. They had their tax expense. They had their bottom line profit. And they did separate that profit out into continuing and discontinuing operations. So they had everything which they were required to have, which is as you'd expect. Material income and expenses. What is material? But these, whatever they are, have to be disclosed separately via either the statement of profit or loss or in the notes. So they need to be disclosed. They don't need to be recognized. And again, recognition is actually in the statements, but that information needs to be somewhere. And what is material? Look, it'll often depend on the size and nature of the item. So if you're a $1 billion business, a $50 expense is not material. If it's a $50,000 expense, it still might not be material. If it's a $50 million expense, it probably is. Now, so there's no hard and fast rule about what is material in terms of size, but the next bit probably gets at kind of what's important is, would the non-disclosure influence users' decision making? So would your decisions be different if you knew about that thing? And so that's quite a, when you think about the reporting decisions, that's quite a tricky one to have to think about. Performance measures. We've touched on a few of them. So we saw gross profit, and this reflects the markup. It's a really important one, and it's a really good one to go and have a look at different types of retailers to see what their markups actually are. EBIT is earnings before interest and tax. So this is how much you earn before you have to pay your interest and before you have to pay your tax. And I suppose it gets a sense of kind of what the operating earnings of the business are. EBITDA is earnings before interest, tax, depreciation, and amortization. So it's EBIT, but then stripping out depreciation expense and stripping out amortization expense. And this starts to get a lot closer to, I'm going to use this word quite loosely, is sort of underlying cash. Is like, what are their underlying cash flows? Like, and again, I'm using that term quite loosely for a good reason, which we'll get to, but it's, a lot of people don't trust accounting numbers. They don't trust depreciation. They don't trust amortization. And so they strip those out to give you EBITDA. Profit from continuing and discontinued operations we have talked about, and is the reason why that's important, and it is important to separate them. And lastly, pro forma earnings. These are earnings that are not in accordance with GAAP earnings. So these are earnings where effectively a company has just made up what this figure is. Now they have to produce their GAAP earnings, so the earnings which are required by the standards. But a lot of companies will then also show these other numbers. They could call them underlying profit. They could call them cash earnings. They could call them a whole range of different things. The important thing with this is they are not a statutory figure. They are not based on any sort of overarching kind of regulatory framework. And a company can choose what to include and what not to include, and they could make different decisions year on year. And you can't really compare that number to anyone else's pro forma earnings because they may have a completely different way of doing it. So the long and short of that is just when you see things like underlying earnings or cash earnings, or sometimes they'll call them non-GAAP earnings, just be a little bit wary about what it's actually telling you. So wrapping up, the statement of comprehensive income and the statement of changes in equity. We'll see some examples from Woolworths in a second. And as always, I would highly advise you to go and have that downloaded and actually look at the Woolworths 2017 report, and then also look at a whole bunch of different reports and see the things that we're talking about. So the statement of comprehensive income, it is required. And what it does is it starts with net profit and then adjusts for some other things. And we'll have a look at what those other things are. And then what you end up with is total comprehensive income. The statement of changes in equity shows how equity changes from the beginning to the end of the period. It shows you how things are affected by profit, because ultimately profit ends up in equity. It shows you income and expenses which bypass profit and go straight into equity. And these are things which go in through the statement of comprehensive income. And finally, it shows you any transactions with equity holders. So if you issued dividends, or if shareholders actually, they issued more shares to shareholders and shareholders provided more cash to the business, it will show that. So to start with the statement of comprehensive income. This is a statement of comprehensive income from Woolworths in 2017. And if we look at the top, we have profit or loss for the period of $1.6 billion. If you were to go back and look at Woolworths' profit and loss statement, that is the number in there. So they've started with the end point from the statement of profit or loss. They've then made a whole bunch of adjustments to it. Now, the sum of those adjustments is only $2.3 million. So it is so small. The previous year was a bit bigger, but this year it was tiny. And there are things like what happens with cash flow hedges, what happens with foreign currency translation reserves, what happens around fair value movements in equity securities, defined benefit superannuation plans, any actuarial gains or losses. We're talking about some of these, I'm not going to say accounting minutiae, but accounting things which the regulators didn't feel fit neatly into profit, but we still need to show that there is an effect. And so they just get lumped into other comprehensive income. And what we end up with is total comprehensive income. So profit shows just kind of the profit effects. Total comprehensive income incorporates everything. No one pays that much attention to total comprehensive income from a user point of view, just to be clear. When we look at the statement of changes in equity, we start with the balance at the start of the year. This is weird. This wasn't even, I suppose, interesting to note. It's not a 30 June year end. It's 26th of June. And when we look at the end, it's the 25th of June. So I don't know why they chose those dates. Maybe there were holidays and weekends and whatnot. But at the end of the year, at the start of the year, I should say, they had $8.78 billion in equity. And that was comprised of share capital, mainly retained earnings, and that was it. So we can see share capital here. We can see share capital, and we can see retained earnings. Then we add profit after income tax, and that profit gets added to retained earnings. There's a few other adjustments, it's really minor, and we end up with total comprehensive income being mainly added to retained earnings, a little bit in other places. We then have dividends being paid, which is the big outflow. So dividends going out in this particular year comes out of retained earnings. And that's what dividends are. Dividends are a distribution of profit. Profit ends up in retained earnings, and then it gets paid out of retained earnings. Lots of other little minor ones which we won't talk about. They did issue some shares, and that's the other big one, which is share capital increases by $316 million. So some of these dividends paid were paid as cash, and some of them were reinvested as part of a dividend reinvestment plan where the shareholders received additional shares. And once you've made all those various adjustments, you end up with a closing balance of $9.88 million. Sorry, $9.88 billion. And what's good to double check with this is if you then to look at the statement of financial position, you will see these items in the statement of financial position. And that's the link. Profit or loss for the reporting period is added to retained earnings at the start. The entity then makes distributions from retained earnings and transfers to and from retained earnings. And then the balance of retained earnings is included as an equity item in the statement of financial position. So profit gets put into the changes in equity account, and the closing balance of the changes in equity account ends up as the equity item in the statement of financial position. It all kind of links together. So to wrap up, knowledge of financial performance is crucial to form opinions about expected performance. The measurement of financial performance requires appropriate recognition and classification of income and expenses, and all the financial statements are interrelated. And that wraps up topic 4, statement of profit or loss.